An overnight data dump says China's economy is slowing fast, that it is failing to deliver on the long-anticipated post-COVID snapback. While it is true that the Chinese regime screwing up is oddly satisfying to many, it also brings new risks to the global economy and especially to U.S. banks. Now, China matters because there are only 3.5 economies big enough to carry the world: U.S., China, Europe, with Japan being half a push. So, with China's failure, all 3.5 are now grinding down. So what happened to China? Their lockdowns were insane. We've all seen residents welded into their houses, or the FEMA camps for anybody who was either exposed to COVID or rude to officials. This, of course, crashed the Chinese economy, as thousands of factories closed and millions were thrown out of work. Still, everybody expected China to snap right back when the lockdowns ended. Apparently, that did not happen. Investment, industrial production, and retail sales all disappointed, while property development continued to fall as a hangover of bad loans. Perhaps most concerning to China's rulers, youth unemployment jumped to 20.4%, which is actually higher than the worst of the lockdowns. Why did this happen? Easy, because President Xi has been squandering the miracle economy he inherited. Over 25 years, free market reforms had built that miracle under 3 presidents, but Xi is different. He is wed to a Mao-era vision of an all-powerful state and has been fighting the free market wing within the Chinese leadership and also harassing both foreign companies and domestic companies instead of courting them as previous presidents had. This all means economic growth in China has fallen dramatically under Xi. So it was 8.6 under Deng Xiaoping. He was the original reformer. And then it went up to 9.8% under Jiang Zemin in the 90s, and then 10.4% under Hu Jintao in the 2000s. Xi has managed to slash that to just over 6%, which is decent for a poor country, but that's more like India or Thailand and nowhere near China's miracle years. In fact, the Chinese stock market has gone sideways for over 15 years now. It's actually down almost half since its 2007 peak. If it continues, a slowdown in China will hit countries around the world. China is a huge buyer of raw materials. It floats countries from Africa to South America to Australia. Roughly 40% of Australia's exports go to China. Meanwhile, widespread discontent, for example, a 20% youth unemployment, could push Xi to conjure up some grand unifying national goal, like, say, reunifying with Taiwan. As for the U.S., the immediate impacts are on 1, banks, and 2, inflation. A slowing China could pull home overseas money the way it did when Japan hit the skids in the 90s. They could pull especially from U.S. banks in the wake of a recent FDIC ruling that apparently confiscates Asian money parked at failed U.S. banks. The second near-term impact is inflation. A weaker China means lower prices in commodities. It also means cheaper Chinese goods. That would bring lower prices for Americans, but don't get excited. The Fed will just print fresh money to mop it all up. But it also means a bigger flood of cheap Chinese goods to also mop up what's left of America's manufacturers. Given how China bullies the world, a slowdown does give us breathing room, but it also brings risks. It would be super to have a financial system and an economy that does not care what China does. Unfortunately, we do not have that. Okay, we'll be watching. See you next time.